We have with us Mr. Pralay Mondal, MD CEO at CSB Bank, to talk to us about Q1 numbers, of course, which have been discussed to some extent, but just about the journey of the bank going forward. First off, good morning, Mr. Mondal. Want to first start off with margins. The shrink was quite large. I understand there's been some recategorization which has led to that margin shrink. But talk us through as to where the normalized margin number is, because you've seen cost of funds also go up quite sharply.
Yes, and good morning to you and your viewers. You're absolutely right that we had a slightly soft quarter in terms of margins and certain financial parameters, but it was a one-off kind of a situation. Specifically, last quarter, there was a regulatory kind of a change which happened for penal interests, and penal interest cannot be taken anymore on accrual basis, and it has to be converted to penal charges, which we are doing from this quarter onwards. So given that, there will be a slight shift in margin compression that has happened last quarter. But broadly, I think our overall guidance between 4.5 to 4.8, which we had, even with the impact of penal interest charges, we should be able to contain it within close to around 4.5% from this quarter onwards and on a full year basis. And some of these compression which will happen on the margins will get reflected in the penal charges, which will come on the fees side. So on a ROA basis, I think we'll be net neutral as a bank from second quarter onwards. And because we are implementing this in the first quarter, it took a little bit of time, and hence we had that impact. On our overall basis, I think from a bank perspective, the way we look at, I think we had given our guidance that we will grow faster than the system by at least 30%, which we have done last quarter. Our deposit grew by around 21%, assets grew around 18 to 19%. And I think we should be able to sustain that, if not better that, in the next few quarters. And in general, the kind of technology investments we are making and the kind of franchise which we are building, we are really fast forwarding our journey towards our SBS 2030 vision of making a full franchise bank and full service bank across the country in larger distribution play. And that is completely intact for our bank. We are all very excited on that. And latest, what we have done is we have also invested ahead of time into the wholesale franchise, which we thought that we'll do it 26 onwards, FY 26 onwards, but that is also starting to play out. And from next year, we'll see our wholesale franchise also coming into play. So overall, I think it's a satisfying journey. Last quarter is an aberration. I think for the whole year, we should be able to do better.
Got it. So I just want to clarify this piece. So you've got margins, of course, which have come off because of certain one-offs, but the recategorization should essentially mean that difference between the normalized margin versus the current Q1 margins should have gone into fees. So what would you therefore believe impacted the ROAs as well as overall profitability?
No, that's a good question. So what happens is when you do penal interest, you do it on an accrual basis. And when you do penal charges, first of all, we implemented it a little late because we wanted to communicate to our customers, because from a regulatory perspective, customer service is also important and you cannot just overnight do it. So we are communicating and we are giving that 1 month kind of a window to customers. And hence, a lot of that which we did will start getting impacted this quarter onwards. Also, accrual and real realizations are two different things. And real realizations always comes with a lag. That's why we'll see that from ROA perspective, this should be reasonably neutral from Q2 onwards. Q1, because of the lag factor, there was a little bit of impact.
And what about full year FY25, sir? Would the Q1 anomaly get corrected over the course of the year, and therefore Q2, Q3, Q4 numbers will be slightly better than what they ought to be? Is that how one can expect it to play out?
100% right. I think our Q2, Q3, Q4 numbers will be a lot better than first quarter. Having said that, there is a structural shift which has happened. That's why we're saying that initially we are saying 4.5 to 4.8%, 4.8% for margins. Now we are giving a guidance on the lower end of that range, which we are already given. So it will be closer to 4.5 going ahead and not closer to 4.8. But that's more of a structural. And as I explained before, that it will move from a interest income to a fee income. So overall ROA basis, I think you should be able to hold on. So overall for the whole year, I think our guidance remains intact, and whatever little bit of a blip we had in the first quarter should be made up in the next few quarters.
Talk to us about cost of funds, because that's probably the other play on margins, because you spoke about margins. Is cost of funds pressure really keeping margins in check, or are you seeing yields and competition is what is playing on the margins? The guidance at the lower end of the band, what's causing that?
See, what's happening is interest rates definitely has been slightly high on the deposits for the last few quarters, because the liquidity in the system has been little, low. Though in the last 1 or 2 months or 3 months there has been positive liquidity in the system. However, because of various reasons, the cost of deposits has not really come down. It is remaining at that level. So overall, I think in the last 1 year, generally, the system costs of deposits or cost of funds has gone up anywhere between 80 basis points to 100 basis points for the system, and we are no aberration there. And corresponding growth in yield has not really happened. So to that extent, there has been a depression. That's why, and it was known before, that's why last year where our NIM was above 5%. This year we had guided between 4.5 to 4.8 based on that. But of course, which I just said before, because of that one change in regulatory norms, it has come down. Our guidance will come down closer to the lower end of 4.5. But overall ROA, it will not be a problem. But yes, there is a deposit challenge in the system, and we are not exception to that. But the good part is our CD ratio or LCR or NSFR, everything is looking good. And to that extent, the liquidity and the deposit franchise overall is looking good for us at the bank.
Right. And so how are you playing this deposits game? Is it going to be a price sensitive game for you, or is it going to be more of a liability franchise kind of game? Are you going to try and build brand, attract customers through services, or are you going to try and play it through increase in cost of funds, cost of deposits?
So of course, the objective should be to build a franchise, because that's the only long-term sustainable model, but it also takes its time. And we are building our entire ecosystem on the technology. We are moving towards Oracle kind of a framework where we are migrating. We are putting a lot of technology in place by which we're building the franchise. We're creating distribution. So that's a slightly long-term play. 2 years from now, we will definitely play the game of building a franchise with all product services and natural growth in the franchise. Short term, I think we won't play the pricing game, but we will be competing in the market compared to what others are doing. And also we are depending on borrowings, we're depending on refinance, the CDs, and various other instruments we are doing, plus CASA and deposit franchise, all of it. So there are 5 components which are playing around, and our balance sheet size is not that large. So with our experience, we can manage that. That's why you saw that unlike most of the players in the system, our actually CD ratio came down to well below 85%. And that was a conscious call we did to ensure that we manage the risk of liquidity very well. So I think we are doing well so far, but we'll not play the pricing game as such.
Okay, so I take your point, and that's good to hear. The other piece is with regard to CASA, right? You're trying to build a liability franchise. CSB in certain pockets, geographies has a very strong liability franchise. You've said that in the past. But CASA seems to be coming off. Is that only because of the shift towards term deposits, or are you seeing some pressure from smaller banks given that they are playing the pricing game and you are not?
No, I think let's be realistic that we are building the CASA franchise, and hence we don't have a very robust CASA franchise at this point of time. So our CASA franchise is very strong only when you have all our product services, and CASA is an outcome of various activities a customer does. And hence, unless we have a proper multi-product backed by technology, CASA franchise will take little more time. Having said that, the entire ecosystem growth is around 13% on the deposit. We have grown by around 21%. And all of that won't happen through CASA. So CASA has not grown that fast. And hence, naturally, the ratio has come down a little bit. And that is to some extent true for the ecosystem. When the ecosystem has grown by around 13-14% on the deposit side, around 13%, you will see that the CASA has also, ratio has gone down by 300-400 basis points for the ecosystem. So to that extent, we are no exception, especially because the growth has been faster on a lower base. So that is how it is working out. So I don't see our CASA going beyond 25% in a hurry. But as interest rate starts coming down, as our franchise starts getting larger, hopefully we should be start moving towards 30% over a period of next 3 years.
Got it. And sir, you've spoken about MSME and wholesale lending. talk to us about the pipeline, the kind of plan that there is over the next 1 to 2 years to scale a couple of these pillars as well, because gold loans you've done so well. Now nearly 50% or 50% plus of your book is gold loans. So now what's the plan in the pipeline now going forward, and how do those businesses scale?
Sure. So first of all, a gold loan is a good business to do because it gives you good ROA, almost nothing in terms of loss. Costs are already baked in, and gold prices are going up. So to that extent, the LTV game is also the kind of a risk-free zone. So to that extent, it's a good business to be done in the short to medium term. But obviously, if you want to build a very large bank over a period of time, wholesale, retail, and SME has to do a lot better. On that path, I think SME is already sort of stabilized for us. Last 1 year, we have started growing on a consistent basis and will continue to grow this year and future. But the good news is in wholesale side, we have built a extremely good senior management out there, leadership out there, who are building a very good franchise, long-term sustainable franchise. And hence we are segmenting our wholesale franchise in a very different way. And you will see a significant growth coming from wholesale franchise from FY26 onwards. That means this year also will grow, but we are correcting some of our portfolio in terms of what segments we don't want to be there and reorienting our strategy around the wholesale. And next year onwards, next financial year onwards, we will see wholesale one of our larger growth kind of a franchise. So overall, I think between wholesale, SME, and gold, and over a period of time, as the technology falls in place, we'll also build our retail a little faster. You will see a very balanced growth across all segments in the bank.
All right. Thank you so much, Mr. Mondal. It's been a pleasure interacting more on the finer points with regard to CSB Bank, and it was a good chat. Thank you. But with that, completely out of time on this edition of the SMID Show. From myself, Mahima, as well as Anushi, and everyone who puts the show together, thanks so much for watching. More on the other side. Stay tuned to NDTV Profit.